Right now, the United States government is actively betting on artificial intelligence to, like, literally save the entire economy from a demographic collapse.
Which is, I mean, it sounds completely wild, right?
Yeah, it sounds like a pitch for a science fiction movie or something. But it is actually written in black and white right into the brand new, massive Congressional Budget Office projections for 2036.
Right, their official baseline.
Exactly. Welcome to this custom-tailored deep dive. We are thrilled to have you joining us today. Our mission here is to take you straight to the structural blueprint of the U.S. economic future.
We want to show you the exact forces that are going to drive inflation, dictate your interest rates, and just generally reshape the broader economy over the next 10 years.
Yeah, consider this your shortcut to being incredibly well-informed.
And to do that, we are unpacking 3 really fascinating sources today. We're looking at a foundational primer on the mechanics of government debt, highly detailed presentation on the costs of fiscal policy, and the crown jewel here, the massive, newly released Congressional Budget Office, or CBO, Budget and Economic Outlook, 2026 to 2036.
Right, and just to level set with you as we dig into this, because we have to address this, the CBO report analyzes some deeply polarizing stuff.
Oh, absolutely.
It's looking at the 2025 Reconciliation Act, the sweeping new tariffs implemented last year, and the recent shifts in immigration enforcement. And I want to be really clear, our goal today isn't to play politics or take sides on any of these policies.
Yeah, not at all.
We are strictly here to look under the hood at the CBO's raw math, remain totally impartial, and just show you exactly how these numbers are projected to reshape the next 10 years. We're just following the data.
Yeah. It is entirely about the numbers, the math, and what the official, nonpartisan baseline projections say about where the world is heading.
Exactly. And let me tell you, I spent the entire weekend reading this dense, number-heavy, hundreds of pages long CBO report so that you don't have to.
You took one for the team.
I really did.
Yeah.
And there's some massive aha moments in here. Like, the way all these pieces fit together is probably not what you might expect.
But before we can truly understand the CBO's wild predictions for 2036, we need to sort of ground ourselves in the financial reality of 2026. Like, what exactly are we measuring when we talk about these trillions of dollars?
Right, the baseline structural deficit.
Yeah, and since you're listening to this, we know you probably already understand the basic difference between an annual deficit, which is when expenditures exceed revenues in a single year, and the total national debt, which is the accumulation of those deficits over time.
Yeah, we don't need to re-explain how government bonds work or anything.
Right. But what we really need to look at is the sheer unprecedented scale of the CBO's 2026 projection. That is what's truly staggering here.
It really is. The U.S. annual deficit is hitting a massive $1.9 trillion this year in 2026.
And it isn't stopping.
No, it's projected to scale up to $3.1 trillion per year by 2036. We are just in a fundamentally different borrowing environment than we were even like a decade ago.
Which brings us to the most critical metric economists use to measure the health of all this borrowing, right? The debt to GDP ratio.
Right.
It compares what a country owes to the total value of what it produces. And according to the CBO, U.S. federal debt held by the public is projected to reach 120% of GDP by 2036.
Which is just a massive number.
It is. To put that into historical perspective,
Yeah.
that completely smashes the previous all-time high of 106%. And that was set just after World War II, when the country had literally fully mobilized its entire economy for a global conflict.
Okay, so let's unpack this for a second, because 120% sounds terrifying on its face. But I kind of want to push back on the panic for a second.
For sure.
Is 120% actually an immediate catastrophe? Because looking at our sources, Japan currently has a 234.2% debt to GDP ratio.
That's right.
That means for every single dollar the Japanese economy earns, their government owes over $2.34. So if Japan can function and, frankly, remain a massive global economic power at over 230%, why is the U.S. establishment sweating bullets at 120%?
Well, what's fascinating here is the underlying mechanism of what we call sustainable debt. You know, sustainability isn't just an arbitrary threshold.
It's not just a red line on a chart.
Exactly. It doesn't mean you automatically crash at 100% or 200%. Sustainability means a government has enough incoming revenue to meet its debt obligations without falling into arrears.
Right.
And Japan is a very unique case. A massive portion of their debt is held internally by their own citizens and their central bank, and historically they have operated in a near-zero interest rate environment.
Oh, wow. So servicing the debt is incredibly cheap for them.
Yeah, precisely. The core economic reality remains at exceptionally high debt-to-GDP ratios. The debt can only actually be paid back, or even just stabilized if GDP grows considerably faster than the interest on the debt compounds, or, if you drastically raise taxes to earn greater revenues.
Which nobody wants to do.
Right. So the U.S. trajectory is so concerning because the CBO projects our debt is going to grow significantly faster than the underlying economy itself. And crucially, we are issuing that debt in a much higher interest rate environment than Japan traditionally has.
So it's less about the total size of the mountain of debt and more about how heavy the boulders are that you have to carry every month, like the interest rates.
That's a great way to put it.
Okay, so if Japan can survive at 230%, the 120% U.S. figure isn't an immediate death sentence, as long as the underlying economy is growing fast enough to carry it.
Exactly.
But when we look at the CBO's growth projections for 2026 and beyond, we see three massive, almost contradictory forces pulling at that exact economic growth.
Yeah, the CBO report explicitly points to three massive policy shifts implemented in 2025 that are actively steering the economy right now.
Right. These are the major levers dictating the near-term forecast. And the first is the 2025 Reconciliation Act.
Yes, and from a purely mechanical standpoint, this act prominently extended lower individual tax rates and, crucially, allowed for the full expensing of business investments.
I really want to dig into that full expensing part because the CBO notes this creates a massive short-term sugar rush for the economy.
It does.
Like, obviously, by putting more money into households through lower taxes, people buy more stuff. But for businesses, full expensing means if a company buys, say, $10 million worth of servers or manufacturing equipment, they can deduct that entire cost from their taxes this year.
Right, instead of spreading it out over a decade like they usually would have to.
Exactly. So it creates this enormous immediate incentive to buy and build right now. And that boosts GDP growth to an impressive 2.2% in 2026.
Which is great in the short term.
But the math on the back end is that this sugar rush adds $4.7 trillion to the deficit over the next decade.
Yeah, there's always a cost.
Yeah.
And then we have the second major policy lever, which is the sweeping tariffs.
Oh man, this part is wild.
It really is. Throughout 2025, the effective tariff rate skyrocketed. It went from roughly 2% in 2024 to about 13% by late 2025.
That's a huge jump.
Massive. Now, strictly looking at the federal ledger, this generated significant revenue for the government. It reduced the projected deficit by $3.0 trillion over the decade.
Right, so that sounds like a win for the deficit.
It does. But the CBO provides a really fascinating, highly specific breakdown of the mechanics of who actually pays that cost, because it doesn't happen in a vacuum.
Right, and this part of the data blew my mind, and it's so important for you, the listener, to understand. Because the assumption is often that the foreign country exporting the goods pays the tariff.
Which is a common misconception.
Exactly. But the CBO notes that foreign exporters only absorb about 5% of the cost. Like, they don't just eat the loss, they pass it down the supply chain.
Right.
Domestic U.S. businesses absorb about 30% of the cost through lower profit margins. Basically, they eat some of the cost just to keep their prices competitive. But a massive 70% of the cost of those tariffs is passed directly to U.S. consumers at the cash register.
Wait, 70%?
70%. You and me buying stuff at the store.
Wow. And that 70% pass-through is what drives the macroeconomic impact. The net result of that is a temporary spike in inflation, which the CBO projects to be 2.7% in 2026.
Because everyday goods just cost more.
Exactly. Consumer purchasing power takes a hit. And it also results in reduced real business investment.
Even with the full expensing incentive we just talked about.
Yes, because companies end up delaying their expansion plans because the imported machinery, the raw materials, the steel, the microchips, all of it just costs way more. Plus, there is general uncertainty about international trade retaliation.
Ah, that makes sense. And then we hit the third major lever from 2025, which is the immigration slowdown.
Right.
The stricter enforcement policies drastically reduced net immigration compared to the massive surge we saw from 2021 to 2024. And the CBO looks at this purely as a demographic input.
Just raw numbers.
Right. A smaller population growth directly and actively slows the expansion of the labor force. And if you have a structural cap on your labor force, you restrict your long-term economic growth.
Yeah, you just have fewer people to do the work.
And it also instantly dampens the demand for new housing construction because fewer new arrivals mean fewer people needing apartments and starter homes.
Exactly. The labor force simply will not have as many new, younger workers entering it as the models previously projected just a couple of years ago.
Okay, so what does this all mean when you put it together? Because we have this bizarre push-pull effect happening simultaneously.
We really do.
Like the 2025 Tax Act puts more money in consumers' pockets and
Yeah.
aggressively encourages immediate business spending. But the tariffs simultaneously make those goods much more expensive and actively discourage long-term business investment due to supply chain costs. It's literally like slamming on the gas pedal and the brake at the exact same time.
That is a highly accurate way to visualize it. And the CBO concludes that the near-term boost in aggregate demand from those tax cuts temporarily exceeds the drag created by the tariffs and the inflation spike.
So the gas pedal wins for a minute.
Right. That is exactly why we are seeing short-term economic growth and a very tight labor market, with unemployment projected to be just 4.6% in 2026. The economic engine is revving incredibly hard right now.
Odd.
But the long-term reality as we stretch out toward 2036 is much more complicated.
Right, because if policy acts as the gas and the brake pedal in the short term, we have to figure out what the actual engine of the economy is over the long term, like what is generating the horsepower.
Exactly.
And the CBO identifies a profound collision between demographics and technology that is going to define this next decade.
Yeah, we are looking at a very real mathematical demographic drag. The U.S. workforce is aging rapidly.
And this isn't a projection, right? It's just a biological reality.
Exactly. As the baby boomers and older Generation X workers continue to retire, the overall labor force participation rate is going to steadily decline. The CBO projects it will drop from 62.5% today down to 61.9% by 2036.
Which sounds small, but that's a lot of people.
It is millions of people. It means a structurally shrinking proportion of the American population is actually working and producing economic output.
Okay, but here's where it gets really interesting. To offset this shrinking workforce, to keep the engine from stalling out entirely, the CBO has literally factored generative AI into its official federal productivity forecasts.
Yeah, which is incredible.
It's not just a Silicon Valley buzzword or a venture capital pitch anymore. The United States government is actively, mathematically relying on artificial intelligence to step in and do the work that retiring humans are leaving behind.
It is a remarkable inclusion in a baseline economic projection. The CBO projects that the widespread adoption of generative AI will boost something called total factor productivity, or TFP, by 0.1 percentage points annually.
Okay, explain TFP for us.
So TFP is kind of the magic sauce of economics. It measures how much more output you can get from the exact same amount of input, so labor and capital, simply because your processes are smarter or your technology is better.
So it's not just adding more workers or buying more machines, it's making the whole factory floor or the whole corporate office fundamentally faster.
Exactly. And while a 0.1 percentage point annual increase might sound like a tiny fraction compounded over a decade, it is massive.
Right, the compound interest of productivity.
Yeah. The CBO estimates this AI integration will increase total output in the non-farm business sector by a full 1% by 2036. And we are already seeing business fixed investment surging specifically to build the massive data centers required to train and run these complex AI models.
It's like we are trying to out-innovate our own demographic decline.
Pretty much.
Like, we are running on a thinner mix of fuel because of the retiring workforce, so we are strapping a massive AI turbocharger onto the engine to try and maintain the same horsepower.
If we connect this to the bigger picture, we are talking about a critical metric called potential labor force productivity. Because the workforce is shrinking, the workers who remain and the capital they use have to be vastly more efficient.
Right.
And a quirky yet incredibly important detail the CBO highlights is that the price of investment goods like AI software, enterprise algorithms, and computing equipment actually grows slower than the price of everyday consumer goods.
Oh, that makes total sense. You can buy a commercial AI license or, automate a logistics supply chain much cheaper than you can hire 50 new analysts or warehouse managers in a really tight labor market.
Exactly.
This makes capital investment incredibly efficient right now. Businesses get vastly more bang for their buck by investing in AI infrastructure than by almost any other metric.
They absolutely do.
Okay, so let's zoom out and look at the whole machine here. We have tax cuts stimulating short-term demand, we have tariffs shifting global trade and squeezing profit margins, and we have artificial intelligence stepping in to boost total factor productivity as millions of workers retire.
It is a highly complex, dynamic machine.
It really is. But what happens when we run this entire economic engine under the crushing weight of that 120% debt to GDP ratio we discussed at the very beginning?
Well, that brings us to the true mechanical cost of all this debt. It's not just a scary number on a screen, it changes how the economy actually functions.
Right.
The first major consequence is an economic concept called crowding out, which is detailed extensively in our fiscal policy source.
Okay, walk us through that.
So when the federal government runs massive, multi-trillion-dollar deficits, it has to borrow massive amounts of money to cover the spread. It goes into the financial markets and issues bonds. But by doing so, it effectively competes with private borrowing for the limited pool of available investment capital.
I used to think of the national debt like a household credit card, where the danger is just the interest payments eating up your budget. But that analogy really falls short here, doesn't it?
It does. It's a helpful way to picture the interest burden, but households can't print their own currency, and they don't issue globally traded bonds.
True.
The true danger here isn't a collection agency showing up at the White House. The danger is crowding out the private sector.
Right, because when the government needs to borrow $3 trillion, it vacuums up all the available capital in the room.
Yes.
And when the supply of available capital shrinks for everyone else, the price of borrowing goes up. And this directly and immediately affects you, the listener.
Exactly.
Because the government is crowding out the private sector, banks have less capital to lend. Therefore, the interest rates on your mortgage, your car loan, and your small business loans stay fundamentally higher than they otherwise would. You are literally paying a premium because you are competing with the U.S. Treasury for a loan.
Precisely. And the second major consequence outlined in our sustainable debt source is the terrifying reality of the debt trap.
Oh, this sounds ominous.
It is. The U.S. government doesn't just borrow money once, right? It is constantly issuing new debt just to pay off the old debt that is maturing.
Rolling it over.
Right. When interest rates were near zero, this was cheap. But when you are forced to constantly refinance old, cheap debt at new, much higher interest rates, the cost of simply servicing that debt explodes.
And the CBO has a staggering statistic on this, and we really need to pause and absorb what this means.
Yeah, this is the big one.
They project that net interest payments on the U.S. debt, just the interest, will increase to an astonishing 4.6% of GDP by 2036.
4.6%.
At that point, interest payments alone will account for nearly 1/5 of all federal spending. Just the yield on past borrowing will actually exceed the entire federal budget for Medicare.
Just let that sink in. 1 out of every $5 the government spends won't go to roads or defense or healthcare. It goes strictly to servicing the debt.
That's insane.
If we look at the historical data, net outlays for interest have not exceeded 3.2% of GDP since at least 1940. We are entering completely uncharted territory for modern federal budgeting.
And this represents a massive society-wide opportunity cost. Imagine what that money could do. Every dollar spent on an interest payment to a bondholder is a dollar that cannot be spent on upgrading the electrical grid, funding cancer research, or subsidizing childcare.
Exactly.
And to escape a debt trap like this, a government typically has to run budget surpluses. But as our sources note, running a surplus means the government has to make politically toxic choices, either drastically raise taxes on everyone or severely slash popular social services.
And implementing either of those historically shocks the system and triggers a recession.
Right.
This raises an important question, though. How long can the government actually sustain this delicate balancing act before a severe fiscal crisis occurs?
Yeah, how long until something breaks?
Well, the CBO explicitly warns that the risk of investors suddenly losing confidence in U.S. debt is growing year by year. If foreign and domestic lenders look at that 120% debt-to-GDP ratio and decide the U.S. is becoming too risky, they won't stop lending entirely, but they will demand an even higher risk premium, meaning higher interest rates, to buy our bond.
Right, they want to be compensated for the risk.
Exactly. And that could cause a sudden, severe spike in borrowing costs that ripples destructively through the entire global economy, essentially crushing that growth engine we just talked about.
It is an incredibly high-stakes tightrope walk.
It really is.
So, to bring it all together, we've gone on quite a journey through these sources today. We started by looking at the sheer unprecedented scale of the CBO's deficit projections and that looming 120% debt milestone.
Yeah.
We unpacked the paradoxical push-pull mechanisms of the 2025 tariffs and tax acts, explaining why you're absorbing 70% of those tariff costs at the register. We explored the fascinating race between the total factor productivity of generative AI and our rapidly aging workforce. And we finally broke down how crowding out actually drives up your personal mortgage rates.
We've laid out the structural blueprint here. We didn't just look at the numbers, we looked at the mechanisms.
Right.
This provides you with the ultimate why behind the headlines you will inevitably see regarding inflation, interest rates, and the job market over the coming decade.
You now know the invisible forces driving the economy. But before we go, there is one final, incredibly sobering thought drawn directly from the CBO report that we haven't touched on yet.
Yeah.
But it's something you really need to ponder as you watch all this unfold.
Yes. The CBO explicitly warns that one of the ultimate long-term risks of this massive accumulation of debt combined with potential inflation is that it could eventually erode global confidence in the U.S. dollar as the world's dominant international reserve currency.
Wow.
I want you to really think about that for a moment. Much of the American standard of living, our ability to buy cheap imported goods and borrow endlessly relies entirely on the global demand for the dollar. What happens to your standard of living and the economy you rely on if the rest of the world simply decides the U.S. dollar is no longer a safe investment?
If the world stops needing our dollars, the entire equation changes overnight. Thank you for joining us on this deep dive into the numbers and the mechanisms shaping our future. Until next time.